bring in our team for the big picture discussion. Michelle Gibley is Director of International Research, and Collin Martin is Director and Fixed Income Strategist at Schwab Center for Financial Research. Michelle, get us started and take us back to overnight. Let's talk a little bit more about what happened in China. It seemed to be kind of a market mover this morning. The stocks are down again. What happens next with this Evergrande scenario?
Now, China's property market issues are well known. The liquidation order for China Evergrande Group, once the largest property developer in the country, is just really the latest in a string of negative news. We've had negative news for 2 years now, and China's stock markets and property developer equities were mixed after the news. Now, it's unclear what will happen after this decision by the Hong Kong court and how it will impact on the mainland and how a liquidation would play out. But regardless, it doesn't really help homebuyer confidence, which was low. One measure that could improve confidence would be the creation of an FDIC insurance fund to protect homebuyer deposits on property. Now, moves by the government last week have given hopes for a floor in Chinese stocks, but more decisive measures, that have rumored leading up to the Lunar New Year on February 10th and the National People's Congress on March 5th really need to be followed through with measures to address the underlying issues in the economy. And that's primarily consumer, homebuyer, and business confidence.
So you think they might
right now, we just need to follow through.
You think they might actually create like a new government entity as a result of this?
Maybe. It would help. There's no rumor of that right now. So, but, if we're looking for new ways of fixing the problem, new stimulus to increase supply without increasing demand, rate cuts, that's not going to help right now.
Yeah. Here, though, it certainly is being bandied about. Let's talk the schedule this week. Like that wrap on China, Michelle. Thanks. Collin, let's talk some bonds here. Today we get this rally. It seems around Treasury's funding announcement. I mean, before we get into the Fed and the rate cut stuff, I mean, do people actually care if we issue $750 versus $800 billion? Like, who cares? Like, what difference is that in the grand scheme of things?
Well, in the grand scheme of things, we don't really think it matters too much, but clearly the markets do, because we saw a lot of movement last year over the past 6 to 9 months based on the deficit and expected Treasury supply. And then today, following the announcement, we did see Treasury yields fall relatively sharply, around 2 to 4 basis points, pretty much across the curve, on concerns that we're not going to see this deluge of Treasury supply. Over time, we haven't seen much of a relationship between the deficit and Treasury supply and what it means for Treasury yields. So you might see some volatility here and there, but when we come up with our outlook for where we expect Treasury yields going over the next 6 to 12 months, the deficit and quarterly supply of Treasuries is not something that we focus too much on.
Okay, so then that brings us to the other stuff this week. Employment on Friday, Fed on Wednesday. Give me the framework that you're using going into Jerome Powell's, not so much a decision, but I guess the commentary surrounding it.
Yeah, what we see on Wednesday, it's really going to be at the margin, because if we look specifically at this upcoming meeting, we don't get updated projections. So we don't have an idea of how the committee sees growth and inflation evolving, nor do we see any updated projections on the path of Fed policy. So we're going to have to pay attention to the statement itself, where there usually isn't too many changes on a meeting-to-meeting basis. And then, of course, comments from Powell in his press conference. In the statement itself, we think they'll probably remove the line that suggests that there could be more policy firming down the road, because we pretty much think we're at the peak right now. And I think there's a consensus amongst Fed officials that they don't need to hike anymore. We'll look for hints from Powell about what the timing of a potential cut would be, but we think he'll probably be a little bit reserved there. Maybe walk back some of the aggressive market reaction we've seen over the past number of months and highlight that the job's not done yet and they don't want to prematurely cut. And then finally, we're looking for some hints about the balance sheet, because once the Fed does begin to cut rates, it doesn't make sense for them to continue with their pace of quantitative tightening, because it's in the name. It's a tightening of monetary policy. That doesn't balance well when they're easing or cutting rates. So we're looking for some clues about what conditions they're looking for to allow them to start tapering their quantitative tightening program, and then some sort of outlook on when it might end altogether.
Okay. I would say that I guess what we learned from the global central banks last week, Michelle, is that even if there isn't like a full-bodied embrace of the market's expectations, the market kind of reads what it wants based on how the market kind of pushed Lagarde and others. Is that fair?
Yeah, I mean, in early January, we had reports of an uptick in inflation globally, and that cooled expectations for rate cuts, but both the ECB and the Bank of Canada meetings were less hawkish than expected last week. The biggest change in market expectations was for the ECB, where a rate cut was pulled forward from June to April. While April's meeting is live and the market's expectations are 75% chance of a rate cut in April, waiting till June could give the ECB more confidence that it doesn't start cuts too soon and have to stop or reverse course later. Stocks could be vulnerable in coming months due to the push and pull of timing of rate changes, and there's really no definitive trend for European stock performance after rate hikes. Or rate cuts. We could see stocks go down, we could see stocks go up, or they could go sideways. So it's really unclear what the coming path is for stocks.
All right. Well, we're going to get a lot of inputs this week. Watch what happens. It's going to be the fun part. Thanks, Michelle and Collin, for the assessment. Good big picture discussion.